Welcome back to the Commercial Real Estate Show. I'm Michael Ball. Today we're talking about REITs, Real Estate Investment Trusts. We have Calvin Schnure and Brad Case with us. They're with NAREIT, the National Association of Real Estate Investment Trusts. And gentlemen, before the break we talked about dividends, and these REITs pay dividends. Tell us a little bit about that, why they pay dividends and why they're required to, right? And then also a little bit of history of maybe some of the dividends that are being paid.
Yeah, sure. You know, a well-managed commercial property throws off income every month as the tenants pay it. And before 1960, you were able to get that stream of income only if you could afford to buy the properties. But what the REITs do is they make it available to individual investors, and specifically, REITs are actually required to pay out at least 90% of their taxable income every year, and generally they pay out 100% of their taxable income, if not more. And so it's very, very similar to actually owning the properties, because if a property increases in value and your ownership comes through owning stock in a REIT, then you participate in the increase in value. But at the same time, every month as the tenants are paying money into the REIT may be making payments out to its investors, and so you have a very, very steady stream of income. If you look at the returns of REITs over a very long period of time, and we have data going back to 1972, but the total returns have averaged better than 11% per year, and about half of that has been income. So income return for REIT investors has been in the 5.5% to 6% range per year for more than 40 years.
That points out another interesting, very important piece about REITs as an investment. When people talk about real estate, many people think, well, I own my home. Why should I own real estate? What we're talking about here is commercial real estate, specifically income-producing commercial real estate. So these are buildings that have leases with tenants, usually long-term leases, so it's a fairly stable, somewhat predictable income source that then is passed on to the individual investors. So just because someone owns a home does not mean they have a well-diversified portfolio where you can get income through commercial real estate.
Yeah, that's a good point, and it's not speculative typically either. Like you said, there's an income stream here that they're buying. I remember when the market got so hot before the meltdown, you know, you go to a cocktail party and everybody's talking about the condos and houses they're buying. They might even be flipping the contracts, and they're buying on speculation, right? There's no income stream there. The REITs, you've got an income stream.
Yeah, in fact, that's an important point. REITs cannot be primarily developers. They cannot be primarily in the business of buying and selling properties. So it's not speculative in either of those senses. The business really is the ownership and the management of these income-producing real estate assets.
And this actually translates into a pretty sizable difference. The current dividend yield on REITs is about 4.2%, which is almost exactly twice the dividend yield on the S&P, 2 times the dividend yield. So if an investor is looking for current income in the form of dividends with the possibility of capital gains on the price increases, REITs give you twice as much as the broad stock market.
Okay, and how about historically, if you go back to say 72 to now and compare it to the market?
Yeah, you know, over the last 40 years, REIT returns have averaged more than 13% per year. Now that's a little bit misleading because 40 years ago happened to be a downtime in the U.S. economy. But over long periods of time, what we've generally seen is that REIT returns have been a little bit better than the rest of the stock market, whether that's the S&P 500, which measures large cap stocks, or whether it's, you know, the Russell 2000 or the R2V, which measures small cap value stocks. REITs have typically provided returns that are a little bit higher than those, with a little bit less volatility. But the most important really benefit that REIT investors have had is that the real estate market cycle is very different from the stock market cycle that drives the returns of essentially all other companies trade in the stock market. And because the real estate market cycle is so different, REIT investors have a diversification benefit that you don't get by investing in other segments of the stock market. If you look at tech stocks and financial stocks and industrial stocks, yeah, from month to month they may move differently, but over long periods of time, they're really driven by the same market cycle, whereas the real estate market cycle is much longer.
Right, and that's a good point for people to acknowledge too, because and also you have the fluctuations in the market will affect REITs, right? So it's not as volatile, but there's some volatility there. Talk to us about that, because it's kind of interesting, because you look at the value of the underlying real estate and the cash flows in the real estate, it probably hasn't changed, but yet the value of the stock is adjusting from time to time, right?
Yeah, for any asset, whether it's a stock or a bond or anything else, the value of that asset is determined by two things. One is the flow of income that you get by owning that asset. For a building, that's the flow of lease payments. For General Motors, it's the flow of the net earnings from selling automobiles. And then the other thing that affects the value of the asset is the discount rates that tell us how much an income flow several years from now is worth in today's terms. Those discount rates change from day to day, and that's something that drives all assets, stocks, bonds, and real estate, even though the cash flows don't change, as you say.
Right.
Something else important to keep in mind when you're looking at listed REITs and their short-term price fluctuations compared with, say, some other illiquid investment that doesn't appear to have a short-term price fluctuation, is those REIT prices are telling you what you could get if you had to sell it today. If you wanted to sell a building, a longer-lived asset, during a period of economic turmoil, yeah, you just might not be able to sell it. That's not going to be reflected in the recorded prices, because those transactions don't take place during the period where some of the buyers might be scared away. So what the REITs are doing, if they have fluctuations on economic news, is they're telling you right now how the economic news affects the value of what you're holding. So it doesn't mean that this is some risk that you wouldn't have if you were in a less liquid investment. It's saying the price of the risk that's in your portfolio. It's the same risks, it's just that the REIT shows that up front.
Yeah, you may have the same cash flows, but in terms of what kind of spending can I finance today because I own this asset, with a REIT, the spending that you can finance today is essentially the same as the value of your stock, because you can sell it today. With a building, the spending you can finance today from owning that building is zero, because it'll take you 6 months to a year to sell it.
Okay, and I want to see if we have time to get into this, but I know one of the questions on the minds of my listeners and viewers is how rising interest rates might impact commercial real estate, and then REITs in particular.
Well, it's certainly been an interesting year. I just want to repeat what Brad was saying about the way that you do the valuations. What determines the value is what income you're going to get paid and what the property is worth. There's a big difference in economic environments where you have a growing economy that is continuing to rise, continuing to generate income for REITs and dividends, versus something that is overheating where the Federal Reserve wants to slow it. There's a big distinction in the market between interest rate increases in a period of rising earnings where you expect more growth in the future, versus something where the Fed is trying to slow the economy, which really is going to hurt valuations quite a bit. And you see that if you look over history, that in most periods, when interest rates are rising, because you can see interest rates are rising because you see stronger earnings potential, REITs do quite well. That doesn't mean that they always do well when there's interest rate news. And actually, that's one thing that we've seen quite a bit lately. One thing that comes out of some analysis that we've done is most periods of rising interest rates, REITs have performed well. But every time that the Federal Reserve has changed its policy rate, or has been contemplating changing its policy rate, REITs have had periods where they sold off. In 2004, they sold off quite a bit. We saw the taper tantrum 2 years ago. After they've sold off, though, you've seen continued rising earnings. REITs did very well 2004, 5, and 6, and they did very well last year. So we've seen a lot of news, a lot of concern about it, but the important point is the rising earnings really do make it a good investment still.
Okay, well, we're going to take a short break here, but I want to talk some more about rising interest rates and how that might impact REITs. So stay tuned. We'll have more for you. Stay with us. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you by Bull Realty, a great place to do business. Xceligent, information for the professionals. And Commercial Search, properties for sale and lease. To access these companies or for additional videos, podcasts, and articles, visit creshow.com.